Hello everyone. This is the second video in the series that we started about financial analysis. We spoke about balance sheet in the last one, and this one talks about key balance sheet ratios. I must emphasize that there are lots of important ratios that also entails some understanding of P&L and cash flow, and we will cover those ratios in the coming weeks. Today, we will limit ourselves to the key balance sheet ratios. We spoke about two matching sides of assets and liabilities in the balance sheet. However, when we calculate the ratios, we would realize how the proportion of certain parts of assets and certain parts of the liabilities make it a stronger or not so strong balance sheet depending on the ratios that we derive. We'll be talking about current ratio, which is essentially a proportion of current assets to current liabilities. Current assets are the ones which are deployed in the short term to carry out the business. It entails cash, accounts receivables from the customers, as well as inventory, which can be the form of raw material or finished goods. On the current liability side, it mainly comprises of accounts payable to suppliers. It could also entail certain expenditures payable. The typical ratio is expected to be 1.5 times or above to basically demonstrate that company has enough liquidity to discharge its short-term obligations. I must emphasize that any loan which is repayable in the next 12 months also forms part of current liabilities, and which is another reason availability of cash to repay not just the ongoing trade obligations but also the debts that fall due in the next 12 months should also be repayable out of the current assets. Quick ratio or asset debt ratio is a more stringent form of current ratio as it excludes inventory. The reason being, inventory takes a longer cycle to convert into cash. It has to be either sold or first converted into finished goods and then sold, and then the receipt of cash from customers converts into cash, whereas accounts receivable could be converted into cash in immediate future. So that's compared to current liabilities. This ratio is expected to be 1 or thereabouts or as high as possible. Debt to equity ratio is a very conventional ratio which is debated a lot at the beginning of any company or a new project or expansions and so on. A right debt to equity varies from markets to markets. In developed economies, usually this ratio is aimed to be kept well below 1, whereas in developing economies, these ratios could be 2 times debt to equity, or it could even be higher. High gearing carries a lot of risk, as we will see in analysis in future. High gearing also provides high return to the equity, and we will discuss that, but it carries with it huge risk. Short-term debt to total debt is a very important ratio, something that a detailed analysis should look at. Short-term debt is repayable within 12 months and it's essentially part of current liabilities, whereas long-term debt is payable at a distant future. Smaller the portion of short-term debt to total debt, stronger is the balance sheet, as the debt obligations only mature in foreseeable future, which can be from 2 to 3 years to 20, 30 or even longer, depending on what kind of instruments the company has while it issued debt obligations. Cash conversion cycle pretty much has an impact on current ratio and quick ratio. Certain businesses require longer conversion cycle, and certain businesses sit in a monopoly situation or a typical trade related situation where they actually have negative cash conversion cycle, implying they have much less cash to be deployed to carry out day-to-day business, and we shall discuss that in the coming slides. Lastly, a ratio which has got a lot of relevance to current and quick ratios as well as debt to equity ratio is long-term capital to total asset. How much is the long-term capital deployed to acquire or invest into the total assets? Higher this ratio, lesser is short-term liquidity risk that a business faces, because more of the funding comes from long-term sources. We go back to a very standard typical balance sheet that we had shown in our previous video and try to show various ratios that we just discussed. So in this balance sheet, the current assets are 30 million, current liabilities including loans repayable in the next 12 months are 20 million. So this ratio is 1.5, current assets being 50% more than the current liabilities. Now if we take out from this ratio the inventory, the remaining current assets to current liabilities is essentially the quick ratio, which is 1.05 in this case. While we carry out these ratios, a deeper analysis would entail looking at aging analysis of receivables and sometime even slow moving or non-moving inventory. The quality of these ratios would pretty much depend on how current are accounts receivables and how healthy is the inventory being carried by the business. If some of these amounts are long overdue, for example for receivables, or inventory is being carried for a long time and is to be written off, then the current ratio may not be as healthy as it may appear. The debt to equity ratio here is the debt is about 50 million, including the short-term debt, which is payable in 12 months time, 10 million, and the remaining 40 million of long-term liabilities, and equity and reserves are 40. So that's a ratio of 50 to 40 or 1.25 to 1. And another way, our debt is 55.5% of the total capitalization, which is 50 million of debt divided by long-term capitalization of 90 million. Short-term debt to total debt is about 20% here, being 10 million divided by total debt of 50 million. It's a healthy, relatively smaller portion. Now let's look at what is long-term debt, and that's very, very important, and another area where a deeper analysis needs to be carried out. There are two instruments in this balance sheet which are long-term: bank loan and bonds. Banks loans typically are amortizing every quarter or so, whereas bonds mature at the end of the maturity. Now bonds could be for 5 years and all the way up to 50 years and sometimes even longer. Longer the maturity of the bonds, healthier it is for a balance sheet, because these obligations do not fall due in a short term. And whenever a business goes through either a low trade cycle or certain short-term difficulties, not having large debt maturities take away a huge burden on the cash flow of the company. We discussed about the cash conversion cycle in our previous video, and I'm just illustrating here by certain examples that if the production cycle from production to selling to the customer, let's take in this example, takes about 60 days, and the supplier is giving a credit of 30 days on the raw material purchase, then effectively the business is holding inventory for 20 days, finished goods and sometimes semi-finished. The customer repayment cycle here is 60 days, so that's 2 months of sales. And in this example, that amount of net working capital comes to $20 million. The last ratio that we want to discuss today is the long-term capital to total assets. And in this case, the long-term capital deployed is equity and long-term loans. So the ratio is about 80%, which is a healthy ratio. Let's take an example that this ratio is slightly lower, where the equity is only 30 million, and this reduction in the equity is actually financed by increase in current liabilities. All of the ratios that we discussed earlier, current ratio 1.5 is reduces to 1 now. Quick ratio was 1.05, reduces to 0.7 now. Debt to equity, which was 1.25, increases to 1.83. Short-term debts, which were 20% of total debt, now increased to 27. And the reason is the long-term capital deployed, which was 80%, is now reduced to 70%. So long-term capital deployed in the business is one very crucial ratio, and this is impacted typically when business starts or a new project or a new action like acquisitions take place or a refinancing take place, and at that time it's very important that tenors of the debt or proportion of the equity are planned carefully so that current ratio or quick ratio is not impacted, which can affect the liquidity profile of the company. We now try to apply these ratios to some of the companies you would hear normally. We have taken these data from publicly available information on these companies and converted them into a US dollar for ease of comparison. We discussed about Samsung and Apple, and you see this is a very interesting comparison. Samsung apparently has all the healthier ratios compared to Apple. It has a better long-term capital to total assets. It has healthier current ratio, quick ratio, smaller proportion of debt to equity, and has literally no short-term debt. However, the interesting part is it has a cash conversion cycle of 34 days in the two periods that we have shown here. Apple has negative cash conversion cycle of 76 to 80 days. Now this is very, very interesting and shows the dominant position that Apple commands. It has very small investments in accounts receivable and inventory, but has huge accounts payable and unpaid expenses. Apple seemingly has slightly lower ratios than Samsung, but if you analyze deeply some non-current investments of US dollar 100 million it holds, some of these ratios would be far brighter and better than Samsung if that cash was assumed to repay some of the current liabilities or debts of Apple. Another very interesting part is the maturity profile of Apple's debt. More than half of its debt matures after 5 years, and some of these analyses are very important for us to understand two comparable companies. Next, we look at China Mobile and Vodafone, nearly comparable companies, except that here also, given the typical nature of a telecom company where you have very limited receivables, but you have some creditors. China Mobile has current ratios which are more than 1. Vodafone had actually less than 1 but has improved in the year that ended on 31st March 2019. Both the companies have negative cash conversion cycle. China Mobile has much less debt than Vodafone has, and that's a very typical capital structure planning that they have adopted versus China Mobile. However, in both cases, there is a significant long-term capital deployed in the business. We look at two mining operators, fairly large-sized ones, and again, the ratios are nearly similar, except that cash conversion cycle of Teck Resources is significantly higher than that of South 32. Otherwise, debt to equity ratios, Teck has slightly higher than South 32. Ratios are all nearly similar. Tata Steel India and POSCO, you see long-term capital to total assets nearly similar. Tata Steel has less than 1 current ratio. Now this is very interesting, and it reflects again a dominant position that it enjoys vis-a-vis its creditors or suppliers versus the customers compared to POSCO. A very interesting and notable difference here is cash conversion cycle. Tata Steel has a very short cash conversion cycle. Its current ratio reflects that versus POSCO, which has almost 4 months of cash conversion cycle. Debt to equity ratios are nearly similar, but Tata Steel has much smaller portion of short-term debt to total debt. We now look at International Paper and Indakiat, two major operators in pulp and paper business globally. International Paper is amongst the largest in the world. Now here we see long-term capital to total assets, and International Paper actually has a smaller proportion of long-term capital to total assets versus Indakiat, but it has again a small current ratio reflective of its dominant market position. It also has higher proportion of debt, but then what's interesting is its cash conversion cycle is much smaller than Indakiat's, which is exceptionally high, and at some stage in future videos we'll look at why, because here it shows more than 8 months of cash conversion cycle. Before we conclude this video, I'd like to highlight few golden rules that define a healthy balance sheet. The liability should be of longer maturity, and a company should have lower asset base. Cash conversion cycle should be as less as short as possible, and every business should look to have healthy cash balance. Thank you.